Liquidity areas part 2. So I had in the last video I made titled key liquidity areas with a list. I had named the key liquidity areas that price must trade run on before you can enter a trade or look for a trade model, entry model. So those were London highs and lows, the Asian highs and lows, previous days highs and lows, and the data highs and lows, and the high and the low of the day. In today's video, I'm going to show you a few more key liquidity points, and I'm going to show you how to avoid entry traps that fail. There's 2 good examples today that I saw. So let's dive right into this right away. I use this indicator called ICT kill zones and pivots, and I just use it in the morning so I can do things quite fast. And what it does is you have to actually go into this little wheel here and change the settings and actually put the times in, because I changed the times around for myself, right? In my area where I live, I'm in Pacific, so I just want to trade in Pacific, so that's what I do. I don't want to do the whole New York thing like the rest of the ICT traders. I just don't really want to, and I might have to convert because of this YouTube channel, but for now, I just use this. You can go into the settings area here and put all your times in. You can see it marks it out with these boxes. You'd have the high and the low of London. Over here, you have the New York AM high and low. So if you're taking notes right now, you can write these down as well. You have the New York AM high and low. Of course, you already know you have your London and Asia high and lows. You have your, I think we already said the New York PM, and you have your New York AMs highs and lows. These times are all on the internet for you to get, right? And then you have your New York lunch high and low, a very key liquidity point when you're trading the first PM macro after the lunch. The target is quite often the New York lunch high or the New York lunch low here, right? New York AM highs and lows, New York lunch highs and lows, New York PM highs and lows. So you can jot those down if you want. I leave them turned off afterwards. It's a little bit too busy for me. And now I want to show you how to avoid these entry traps that happened this morning in the first AM macro. You can see here right off the open, 6:30 AM candle, and the price just shoots out of here and takes out London kill zone here, which, you know, of course you're looking for sells here now. I get it. But then we go deep into this 4-hour fair value gap right here. I've marked it out for you right here. It's this red box right in here. And here is trap number 1 right in here. You can see here we have displacement over sort of this breaker block right here. We have displacement here over this breaker here. So what happened here is you have this bearish gap here for your entry, and price just went the other way, right? And the reason for that is there isn't enough liquidity that's been taken inside of this bearish gap. You can see that it came up here in the first AM macro here, okay? And if we go to a higher time frame to look, we're on the 1-hour time frame here, and you can see there's no key points of liquidity in here. It's going to engineer some liquidity, and it's going to be an entry trap like I've just showed you. We have the high of London on Friday's London up here, but it isn't really a high, right? That's just where the time was. The next relevant high is up here, and I have it marked in up here. That's your Asian high. It's a sufficient high. And right above it, though, you have the previous daily high, though. So you can see there wasn't enough liquidity, and that's what it did. Back to the 1 minute here. This was the first AM macro fail. We'll go to the second AM macro, and I'll show you the second trap. Second trap at 7:45 here. You can see we have this slight displacement right here over this low right here. This being the breaker here. This is the breaker here. We've also taken out, we do have these highs right here. So if you did enter this trade and it happened to go this way, I could understand it. It's not a horrible trade. It's not necessarily trading outside of the model. It's just you have to understand these things. Like this high here, we don't have a change of character really here, right? If we had a major change of character and it came into here and then took these highs maybe, but at this point I knew it was already going to fill this gap when it was up here, right? Anyways, so I needed a little bit more confluence on this trade, okay? So let's go over some liquidity criteria on what price must do inside this 4-hour fair value gap. So we want to look for relative equal highs and lows. And over here, we didn't have any relative equal highs and lows. We're looking for the previous session highs, London highs, Asian highs, like we said, with our indicator, and we could not find any in here. Minor swing high created after entering the FEG. Well, we do have this minor here, but it isn't quite enough, right? It technically is. So again, if you took this trade, I get it. There's a very tight stop on this anyways. Like, I think the stop on this fair value gap here was really small. Yeah, you have a 12-point stop on that. I want to avoid these entry traps. Was there no liquidity sweep? No trade. A quick dip, then return is just accumulation or bait, not displacement. If price just trades into a lower time frame bullish fair value gap and reverses immediately, it's probably engineered more buy-side liquidity, not the start of a real bearish move. We're looking for that clear of liquidity of all the key points that I mentioned before we can get into a trade, and things will actually be a lot smoother if you do. And you can avoid losses like this one and this one right here. I'll be trading live on Wednesday and Thursday of this week, okay? So I'll catch you on my live trades. Thank you.